Hi, everybody. Good morning, and thank you for joining us for this Power Play Tuesday. My name is Zach Wilson. I'm one of the IRA specialists here at Quest Trust Company. So, today's topic is something that I'm really excited about, and I'll expand on it a little bit more. So, let's just jump in. So, first, got to give you the disclaimer. Everything that you're about to see here is for your educational purposes only. It's important to understand the role that Quest will play when it comes to your retirement investments. We're really here to facilitate the transactions that you need and offer as many educational resources and investment resources that we can to our clients and investors. But with that being said, Quest does not offer any sort of tax, legal, investment, or structuring advice, nor do we endorse any specific investments. So for those of you who don't know us, we are Quest Trust Company, and we're a self-directed IRA custodian. But really, what is a self-directed IRA? But really, believe it or not, there is no such thing as a self-directed IRA. It's really just a marketing term to illustrate you're the one in control of the investments. So the self-directed traditional or the self-directed Roth you would have here at Quest is identical to the traditional Roth you would have at a custodian like Fidelity, Schwab, Vanguard. The only difference is the custodian themselves. They allow you to take those funds and invest them into public assets, whereas Quest allows you to take those same retirement funds and invest them into private assets. These are things like real estate, private entity, promissory notes. So you can take direct title to property. You can be a private money lender out of your IRA, or you can invest into things like syndications, right? More passive investments utilizing those retirement funds, which is really what they're designed for. So if you have any questions and you're looking, to get some questions answered regarding your financial future on how you can utilize your retirement funds to invest into alternative assets, feel free to follow the QR code, set up a consultation. It's completely free. You'll be able to talk to one of our IRA specialists and get a game plan set up of where you are, where your funds are sitting, what investment strategy you'd like to pursue, and we'll fill in the gap on how you can get there. So again, for today's topic, I'm really excited about it. And the reason being is because a lot of people, when they're making these investments and they're thinking, okay, how can I maximize my tax savings? They start thinking of the vehicles that they can use, right? The accounts. And that's where Quest comes in. Quest comes in with the accounts. However, that is only one portion of the overall game plan, right? Of overall what your investment strategy should be. Because the other section is going to be the actual investments themselves and how you can utilize those investments to maximize those tax savings with the passive loss rules. So our speaker today is Brandon Hall. Brandon Hall is a CPA, a national speaker, and is the founder and managing partner of Hall CPA PLLC, or the real estate CPA. Prior to opening his own firm, Brandon worked at PwC and EY, and he works with real estate investors, syndicates, and private equity funds to optimize tax positions and streamline accounting and business functions. He believes that the real estate investing is critical to and generational wealth. Through the knowledge gained by working with real estate investors, Brandon has built a real estate portfolio of 25 units consisting of multifamily, single family, and short-term rentals. And so I'd love to get his insight on how you can maximize those tax savings using these passive loss rules. So without further ado, Brandon, the floor is yours.
All right. Thank you very much, Zach. I appreciate the intro and appreciate everybody's time and listening to a tax presentation. So today I want to tell you all about the passive activity loss rules. And I want to start by talking about why you should care. Everybody in the United States is subject to the passive activity loss rules, but oftentimes we don't find out about them until we start investing in real estate. So that's kind of the interesting thing about this. Every single taxpayer is subject to these rules. But what happens is the passive activity loss rules essentially create two buckets of income. So you've got the passive income bucket and the non-passive income bucket. And the problem with the activities that go into the passive income bucket is that if those activities generate losses, the losses can only be used to offset passive income. So rental real estate, for example, automatically goes into the passive bucket. It generally creates passive losses, but the passive losses can only be used to offset passive income. And sometimes if I'm doing this presentation on stage, I'll raise my hand and be like, who has passive income? And nobody has passive income. Because we're building our portfolios, right? We're not like at the end where we've stripped out all the depreciation and we have so much cash flow coming in that it's creating a ton of passive income. So what happens is we have all these passive losses that are being generated in this passive bucket, but all of our regular income, our W-2 income, our business income is in the non-passive bucket. So our passive losses can't jump out and offset our non-passive income. unless you qualify for a couple exceptions to the rules, which we're going to talk about here today. So that's the first reason you should care. But the second reason that you should care is if we can't use the tax losses, then we're not optimized under the time value of money rule, right? Time value of money says that a dollar today is worth more than a dollar tomorrow, in part due to inflation and also in part due to being able to reinvest money and earn more money. So if I can't use my losses today and they get suspended and carried forward, then the tax benefits associated with those losses I also can't use today, right? But they lose value over time. So if I have a $20,000 tax loss and I know that that $20,000 tax loss produces a $6,000 tax benefit, if I can use the tax loss today, if I know that tax benefit is worth $6,000 today, but I can't use the $20,000 tax loss, then maybe I can use it 10 years from now. But what is the $6,000 tax benefit worth in 10 years when I'm actually able to use it? Right? It's going to be worth a lot less in real terms because of inflation. The price of goods have all increased, but that same $6,000, it's still the same $6K. So that's why we should care about these rules, because we're investing in rental real estate. Rental real estate is by default going to be passive. Passive losses can offset passive income, but most of us don't have passive income. So the passive losses just get suspended and carried forward. They just accrue and accrue and accrue. And while it's not the worst thing in the world, it's not optimal, thanks to the time value of money. So before we jump into, how to get around the passive activity loss rules, I do want to start with some history, because I think it's important to understand the intent behind the rules, and that will hopefully influence the decisions that you make related to how you try to get around the passive activity loss rules. So back in 1986, that's when these rules came into play. Section 469 of the Internal Revenue Code. Prior to 1986, anybody could be a landlord, and you could use rental losses to offset your regular income. So you could be a physician earning $800,000 a year, invest in rental real estate, and wipe your income out. You could be running a business totally unrelated to real estate, buy rental real estate, and wipe your income out. Congress decided that they didn't like the fact that rich people could use investing in rental real estate to offset their income, essentially as a tax shelter. So they implemented Section 469. And Section 469 basically says that's what, well, let me move to the next slide. There we go. Section 469 says all rentals are passive unless you qualify as a real estate pro, and any trade or business that you do not materially participate in is also passive. So real estate, unless you qualify as a real estate pro, every single rental that you have is going to be passive by default. And then any trade or business that you don't materially participate in will be passive. And passive losses can only offset passive income. And unfortunately, literally all of our other income is going to be non-passive. So our W-2 income, our business income, that's all non-passive. Interest income, capital gain from stock sales, dividends, that's also all considered non-passive most of the time. So like basically the only thing that is passive is rentals. And then any business that I don't materially participate in that is structured as like an LLC or an S corporation. And a business that I don't materially participate in, the example that I like to use is, let's say that my local hair salon calls me up and they go, hey, we know that you invest in businesses. We're looking for expansion capital. We're structured as a partnership. You give us $100,000 and we'll give you $10,000 a year of profit, roughly. That's what our models show, right? So I give them $100K. They use that for expansion capital. They pass profits back to me equal to $10,000 a year. And I don't materially participate in the operations. I'm not voting. I'm not meeting with the board. I'm not doing anything, right? All I was just a capital investor, and now they're giving me money. That is passive income. And that passive income can be offset by rental losses. There's a tax court case, Hardy versus Commissioner, where a surgeon invested in a surgical center, was not materially participating in the surgical center itself, and was able to buy rentals and use the rental losses to offset the surgical center income. So first main point is that a rental loss is ordinary in character, and business income is ordinary in character. And so losses that are ordinary can all offset each other. A lot of times we'll see accountants say, well, rental losses are like, they're just different. You can't use rental losses to offset other types of income, which is not true. The limiting factor is just, is it passive or is it non-passive, right? But if you have everything in the passive bucket, then that's great. The passive activity loss rules are less of an issue. And this is actually something that a lot of our high income or our wealthiest investors and clients end up doing. They do something called passive activity netting, where over time they acquire stakes in businesses that they don't materially participate in, and those businesses produce passive income. And then they simultaneously buy a bunch of rentals, and those rentals produce passive losses, and it all nets out. So they're making all this money from the businesses, and they're paying no tax on that today, because the rentals through depreciation are creating tax losses that offset them. But if they didn't have the business income coming in and they were just buying a bunch of rentals, the tax losses would just get larger and larger and larger, and they would be suspended because they're all passive. So the rents from rental real estate, or the rentals, are going to be passive. Businesses that you don't materially participate in, those will be passive. You can get around the rules, but the point is that the passive activity loss rules exist to prevent rich people from using rental real estate as a tax shelter. So it's challenging to move your rental out of the passive bucket and into the non-passive bucket. But we'll talk about how to do that specifically. Before we jump into the next piece here, just one more thought on why these rules came into existence back in 1986. So Congress was thinking that rentals produce tax losses even when they're profitable, which is true, right? Most of us that invest in real estate, we have cash flow, positive cash flow. That after depreciation, we show tax losses. So depreciation shelters our cash flow today. We're not going to pay tax on that today. And we also have a tax loss that we could potentially leverage to offset our other income. So Congress thought, that's not really fair. So we're going to trap those tax losses at a very bare minimum. The other thought too was that the material participation standards were just too low. So they added real estate professional status, which makes it much harder for individuals to move the rentals out of the passive bucket and into the non-passive bucket. To help this hit home, I've got a couple slides on examples here. So if our revenue is $40,000, our expenses are $30,000. That's from our rentals. Our net operating income is $10,000. We made money, right? Whether that went to pay off our loan or went right into our pocket, just kind of depends on our financing. But regardless, revenue minus expenses, we have $10,000 of net operating income. We also have depreciation expense of $20,000. So once we factor that depreciation expense in, our net loss is $10,000. On the left-hand side, if the net loss is passive, then it gets suspended and carried forward. We get no tax benefit from it today. On the right-hand side, we're assuming that it's non-passive. And that should actually say non-passive, if the losses are non-passive. I caught this last time I used this too. I was like, dang it, I need to make that update on slide 5. Anyway, on the right-hand side, the right-hand column is supposed to be non-passive. So we've materially participated. We qualify as real estate pro. The rental is now offsetting our regular income. Now the $10,000 tax loss turns into a $3,700 benefit, assuming, of course, that we're in the top tax bracket. And if we add bonus depreciation onto this, now we've got the same $40K of revenue, $30K of expenses. Net operating income is $10,000, but now we have $60,000 of bonus depreciation in the first year. We do a cost seg study and accelerate everything. The tax loss is now $50,000 rather than 10. And if it's non-passive, that tax benefit moves up to $18,500. So learning how to get around the passive activity loss rules puts real dollars back in your pocket. If with all of our clients, not all of our clients, most of our clients that can navigate around the passive activity loss rules, with them, we're running the cost seg studies, we're accelerating bonus depreciation, and we're seeing large tax losses go and offset the regular income. Now, if you're investing as an LP, it changes a little bit, right? Like you don't have control over the syndication or the fund. So you can't, you lose some flexibility under the passive activity loss rules simply because you don't have that control. However, you still have some opportunities. So for the first example, I kind of already mentioned it, Hardy versus Commissioner. This is a real example where the surgical center or the physician invested into a partnership where he didn't have control. He was an LP. The income coming back to him was passive, and then he went and he built his own rental portfolio out to create passive losses to offset the passive income from this LP investment. Okay, so that was how he sheltered the income from the LP investment, because that income was passive to him. He was not materially participating, and he went and built his own rental portfolio to use the tax losses to offset that income. Now, the IRS didn't like that, and they audited him, and he ended up in tax court, but he did win in tax court. The second example is that hair salon example, right? So maybe you invest $100,000 into the hair salon, you get the $10,000 passed back to you, but then you go and invest $100,000 into a real estate syndicate or fund, and they're going to pass $50,000 of tax losses back to you. Well, the $50K of tax losses, those are passive. The $10,000 of income from the hair salon, that's passive, because I have $10K of passive income and $50K of passive losses. They net out against each other, and then $40,000 of passive losses get suspended and carried forward. The third example is something we like to do with our LP investors a lot. We execute something called a lazy man's 1031 exchange. If you're investing in real estate through a syndication or a fund, what you own is a partnership interest, whether or not you do this personally or in a self-directed IRA or 401k. You have a partnership interest, and you cannot 1031 exchange a partnership interest because partnership interest is not real property. You can only 1031 exchange real property. So the partnership owns the underlying real property, but you do not actually own the underlying real property. You own a stake in the partnership. So you can't do a 1031 exchange, but you can do a lazy man's 1031 exchange. Now, the way that this works is, let's say that an LP, let's say that a syndicate liquidates, and they pass you $100,000 of gain back in the same calendar year. It doesn't matter when these two events happen. It doesn't matter when they sell. It doesn't matter when you buy, as long as it's in the same calendar year. So you could actually do this before they sell. On January 1st, you could make the lazy man investment. And then on December 31st of that same year, they could finally sell the original investment, and you will have executed this. But stay with me. So they sell, and they pass you a $100,000 gain, taxable gain. You take that 100K plus maybe another 50K. You invest 150K into a new syndication or a new fund, and they're running a cost seg study. They get the bonus depreciation, and they pass you back your allocable share of bonus depreciation. And let's just say it's $90,000. Okay. So in the same calendar year, we have an LP investment that produced a 100K taxable gain. We also have an LP investment that's a new investment that produced a $90,000 tax loss because they ran a cost seg study and bonus depreciation, and my allocable share of that was $90,000. So I get a $90,000 tax loss. Those two things net out. All right. So this is how LP investors can mitigate their tax positions. They can do a lazy man 1031 exchange. They can understand how passive income coming in from businesses can be offset by passive losses from real estate, or even vice versa. To continue this lazy man sort of idea, if you time your LP investments, you can really maximize it under the tax code, right? And the key caveat here is that this is a tax play, and you always should be investing for wealth first, tax benefits maybe second or third or even fourth. But if you wanted to kind of see how this lazy man 1031 exchange works, or how you might stair step this up, here's how it would work. Let's say you have $500K today that you want to invest, and you came to me and you were like, I don't care about building wealth, which nobody would ever do. But just for this example, I don't care about building wealth. All I care about is not paying taxes. I might tell you, okay, don't invest $500K this year. Let's invest $150K this year, $150K next year, and then the remaining $200K in the third year. So you can see in my example, 2024, 2025, 2026, right? So in the first year, we invest $150K, we get a $100K tax loss. Second year, we get another $100K tax loss. Third year, we get a $150,000 tax loss. So at the end of 2026, we have $350,000 of total tax losses thanks to these investments that we've been making. Well, then in 2028, right? So we wait a few more years. 2028 sells, or my first investment sells. They allocate 150 gain to me. Cool, great. I use the 350K of tax losses to offset the 150K of taxable gain, and now I have 200K left. 2029, the next year, the next 150K liquidates. Now I've got $50,000 of tax losses left, and then in the third year, I finally have taxable income. The purpose of showing this to you is that you can figure out ways to optimize your portfolio for taxes by timing the investments that you're making and being very cognizant of what the sponsor's plan is with the property every single year. So we started investing in 2024, but we didn't actually pay any taxes until 2030. What are we able to do with those tax savings over this span of time? We reinvest them, we grow them. Ideally, right? We're not buying Ferraris. We're going to go and buy indexes or more property or whatever, but we're going to continue growing this capital. So it's just an illustration of how powerful the timing of your investments can be. Okay. So that was like a little commercial, if you will, for LP investors. Not a commercial, but just like a little sidebar. Now let's get back to the bulk of this presentation, avoiding the passive activity loss rules. So we've already kind of covered back in 1986, these rules were put into place because Congress didn't want rich people to use rentals to create tax shelters for their income. So they said, hey, all rentals, unless you qualify as a real estate pro, they're passive. And then any trade or business you don't materially participate in, that's passive too, unless you qualify for one of the exceptions to the rules. So there's 4 main exceptions to the rules. The first is if you sell a passive activity at a gain, you can use losses from other passive activities to offset that gain on sale. So not really like a workaround per se, but just something that happens when you sell a passive activity at a gain. And this also does not matter if you sell a rental or a business. If you are allocated gain from the sale of an activity that is passive to you, then you can use other losses that are passive to offset that gain. The second workaround, or the second exception to this rule, or the passive activity loss rules, is if you earn less than technically $100,000, you get a $25,000 passive loss allowance. All that means is if I earn less than 100K and I'm investing in rentals and my rentals produce passive losses, I can use $25,000 of those passive losses without having to jump through any hoops. All I have to do is make management decisions, which I can do even if there's a property manager on the property, and I have to own at least 10% of the activity. Now, as my income creeps up above 100K, that $25,000 loss allowance starts to phase out, and it's 100% phased out when my income reaches 150. So sometimes we get clients that'll be at like the 155K mark, and they'll say, well, I'll just contribute $6,000 to my 401k, and now I'll have $149,000, and now I can use the $25,000 loss allowance. But the way that this phase out works is if you've got 149K of income, you only get a $500 loss allowance. So you have to understand that the phase out starts at 100 and it's done being phased out when it hits 150. So to really maximize the usage of this rule, you'd really kind of need to be in the 120K income range. And that could be after contributing to retirement accounts and things like that too. So you can game the system a little bit to maximize the return under the passive loss rules. The third way is to qualify as a real estate professional, and then we have a bonus, which is buying short-term rentals, which we'll talk about both here next. So to qualify as a real estate pro, so qualifying as a real estate professional allows you to overcome the presumption that rentals are passive, right? Because remember, there's 2 types of passive activities that are stuck in that passive bucket. All rentals, unless you qualify as a real estate pro, and any trade or business that you do not materially participate in. So if we qualify as a real estate pro, we just meet that first bullet point. We get rid of that first one, which says all rentals unless you qualify as a real estate pro. But we still have to materially participate. If we don't materially participate, it's still passive. And this is actually, I've seen a few horror stories where people, they qualify as a real estate pro because they are a property manager full-time, or they're a real estate agent or broker full-time, or they flip houses full-time, or they're a developer full-time. You're a real estate pro if that's what you're doing full-time. But if you don't also materially participate in your rentals, they are still passive. So qualifying as a real estate pro in and of itself does not make your rentals non-passive. And remember, we want to make the rentals non-passive because then we can cost seg, we can use the depreciation from the rentals to offset our regular income. So it would really stink to qualify as a real estate pro and then forget that I still have to materially participate in the rentals in order to do that, right? But people do that, and it's a sad story when you have to walk them through that. So how do you qualify as a real estate pro? There's 2 tests. First, you have to spend more than 750 hours or more in real property trades or businesses. The second test is that you spend more time in real estate than you do anywhere else. The second test kicks out anybody with a full-time job automatically. Now, A full-time job is 2,000 hours a year with 2 weeks of vacation. So technically, you can spend an additional 2,001 hours working in real estate for a total working time between your full-time job and real estate of 4,001 hours during the year. Technically, you can do this, right? I mean, there are very demanding jobs out there, so it's not unheard of to see people, especially earlier in their careers, working 80-hour weeks. The problem is that the IRS and the tax court will never buy it. Many people have tried to pitch this fact that they spend more time in real estate than they do at their full-time job. Every single person has lost in tax court. So, for the time being, it is impossible to spend more time in real estate, or impossible to convince the IRS and tax court that you spent more time in real estate than you did at your full-time job. Therefore, if you have a full-time job, you cannot qualify as a real estate professional. And again, that is a big bummer, because you have to qualify as a real estate professional in order to make your rental losses non-passive. That's step one. Step two is material participation. So if you can't qualify as a real estate pro, then your rentals are passive, and they're just going to be stuck passive, and those losses are going to be suspended and carried forward if you don't have passive income. But let's say that you might be able to qualify as a real estate pro, and you're looking at that 750-hour test and the more time in real estate than anywhere else, and you start wondering what time counts and doesn't count for the 750 hours. The litmus test for figuring this out is if the day-to-day operations of your rentals are unaffected by the hours that you're logging, then the hours don't count. So what I mean here is, if you go on like a cruise, a real estate cruise, and it's a big educational social thing, you can't count any of the time, right? Because if you didn't go on the cruise, your rents would still be collected, your bills would still be paid. It's not like you going on the cruise significantly altered the operations of your rentals, right? Same thing with education and research hours. Spending all day on the MLS does not impact the day-to-day operations of your current rental portfolio. So really important to understand that in order for any of these hours to count, I have to be actually running the day-to-day. Now, if you're a real estate agent or a property manager or a flipper or a developer, you are running the day-to-day, right? You're not outsourcing that stuff. You are the one that's showing the properties to prospective buyers or to tenants. You are the one that's buying the materials and doing the walkthroughs and managing the contractors and all that type of stuff, right? So you are involved in the day-to-day. That's why if you are a real estate agent, property manager, developer, flipper, etc., you are, all the time that you spend is going to count, because if you didn't spend that time, your day-to-day operations of your business would be impacted. But when we get to rentals, we do some weird stuff, right? I have a full-time job. I make $300,000 as a physician or a salesperson or an executive or whatever. And I don't have a lot of time to spend on my rentals, but I can certainly sit online and look at the MLS all day long, right? I can certainly listen to a podcast. I can certainly do all these things that are fluffy hours that don't actually impact the day-to-day operations of my rental. So that's kind of the litmus test to consider. But let's dive into it a little bit more. So let's first start with what specifically does not count. Now, there's a lot of things that don't count, by the way, but these are the 3 buckets of hours where we have seen time and time again the tax court say, sorry, those hours do not count, and you lose. The first bucket of time is investor level hours. If I'm not involved in the day-to-day management of the rental, this is when this hurts me, right? Investor level hours do not count if I'm not involved in the day-to-day management of the rental. If I am involved in the day-to-day management, meaning I self-manage, right? I don't have a property manager. If I am involved, then all of a sudden all my investor hours do count. But investor hours are studying, reviewing, and monitoring financial statements, bookkeeping, underwriting deals, coordinating, closing, talking to my mortgage broker, my property broker, my attorney, getting insurance, basically anything that any investor would do. That is what it would be considered an investor level hour. And again, that time can count if you self-manage the property. But if you don't self-manage the property, then you're just an investor. You're not actually a real estate professional. The second bucket of time that does not count is education and research hours. I've got 2 tax court cases there, Halfpour versus Commissioner and Padilla versus Commissioner, because typically when I talk about education and research hours not counting, there's always somebody in the crowd that's like, no, that's not fair, and all that time is important. And I agree, it's important, but the tax court doesn't think that it actually impacts the day-to-day operations of your rentals. So Halfpour versus Commissioner, Padilla versus Commissioner, most of the hours, most of the time logged on their time logs was education time or research time. The tax court denied that time. I believe one of these cases, I think it was Half-a-Pour. They actually went to seminars, multiple seminars out of state. Tax court denied the seminar time, the travel time. So again, like if you're going to networking conferences or big educational events or listening to podcasts or whatever, or this presentation too, none of that time is going to count for real estate professional status. It might make you a little bit better of an investor, might expand your network, and it might be important, but it's not going to count for real estate professional status. The last bucket of time, the third bucket of time, is travel time with an asterisk. So the IRS Audit Technique Guide says that travel time does not count for real estate professional status. However, there's a tax court case in Lay versus Commissioner where the tax court ruled that travel time can count and did count for this taxpayer. Now, the unique thing about Lay versus Commissioner was that they were self-managing and they had a bunch of rentals that were local to them that they visited multiple times a week to ensure that they were in good operable condition, to manage the tenants, collect rents, do landscaping, maintenance, etc. So it was basically this person's job to drive out to the properties on an ongoing basis weekly to make sure that their rentals were good and that their investments were solid. The tax court essentially found that if they didn't do that local travel time, then the properties may not have performed very well. So they said, yeah, the travel is integral to the day-to-day operations. They did allow the travel time to count. But where you always see travel time not counting is when I have a property that's an hour plus away from me and I'm visiting it once a month or once every other month. Travel time is not going to count in that type of scenario. So that's what you need to be aware of there. So let's talk about what does count, right? That was a bunch of doom and gloom. So let's move it to a little more of a positive look. What does count? Hours spent acquiring property, showing the property to tenants, placing rental ads, taking tenant applications, screening tenants, negotiating leases, cleaning units, maintaining the grounds, doing repairs, doing improvements, supervising a property manager. We'll come back to that one. Purchasing supplies and materials, inspecting the property, communicating with tenants, collecting rents, evicting tenants, traveling to your rentals. All of this sounds like a property manager to me, right? I mean, if you look at all this, that's a lot of work, and that is what a property manager does. So if you have a property manager on your rentals, you cannot use the hours for that property. Or I would say you cannot use the vast majority, if I had to put a percentage on it, 90% plus of the time that you spend managing a property where a property manager is on it. You're not going to be able to use 90% plus of the hours that you're spending because they don't actually make the property go, right? They don't impact the day-to-day operations. The property manager is doing all of these things. You have two choices, right? You can either get rid of the property manager and self-manage, or you can split duties with the property manager. So there are cases where people have tried to split duties with the property manager. Some people lose, some people win. The people the difference between winning and losing, if you're splitting duties with the property manager, the difference between winning and losing is you have to have an agreement with them that clearly indicates what they are responsible for and what you are responsible for. And this is where people almost always lose whenever they try to claim that they're splitting duties, because the IRS just pulls up the property management agreement. And the property management agreement says that they're doing all this stuff. Even if you are doing this stuff, they're going to say, too bad, we believe the property management agreement. So you do have to make sure that that property management agreement is not a standard template. If you're going to be splitting duties with your property manager, you do have to go in and very clearly call out what they're responsible for and what you're responsible for, which in reality is smart to do anyway, because you want to set clear expectations. Now, on the right-hand side, second bullet down, I said we're going to come back to supervising a property manager. I always get calls, and I always get calls about this. People are like, hey, I've got a property manager on my 3 rentals that are three states away from me, and I want to count the time that I spend supervising them. So I have I call them 2 times a week, and we talk about progress and updates and things like that. Does that time count? And the answer is no, that time's not going to count. Where supervising a property manager can count is when your portfolio is so large that this is effectively your job. But by that point, you're probably a real estate professional anyway. So supervising a property manager is not even an issue. So in general, calling every property manager once a week, once a month to check in, get a status update, that is not time that's going to count, because that's investor level time. You're not involved in day-to-day. Your property manager is involved in day-to-day, not you. So just something to be aware of there. Okay, so let's say that we qualify as a real estate pro. All right, so that first bullet point, section 469, all rental real estate is passive unless you qualify as a real estate pro, and any trade or business you do not materially participate in is passive. So let's say we qualify as a real estate pro. We meet that test. We still have to materially participate. There are 7 tests for material participation that you can see here. You only have to meet one of them. You do not have to meet all 7. These are ORs, right? You only have to meet one. The ones that our clients meet most often are number 1 and 3. Participate more than 500 hours in the activity or participate 100 hours and more than anyone else. The 500-hour test is typically met when we have a larger portfolio and we're grouping the portfolio together with the 9G election. There's an election to group all rental real estate together into one activity for the purposes of material participation. If you don't do that grouping, and it's very easy to forget about. And if you forget about it, the IRS under audit, if they find it, they will stick to the fact that you never made the grouping, and too bad you lose. So make sure that if you have a large rental portfolio that you get this grouping election done. Because if you don't do the grouping election, you have to materially participate in each rental separately. So if you have 20 rentals, how are you going to hit 500 hours in each of those activities, or even 100 hours and more than anyone else in each one of those activities? That's a lot. But if you have 20 rentals and you group them all into one activity, now it's 500 hours across the entire portfolio of 20 rentals. A lot easier to do. So that's what most of our clients typically do. Now, our clients that are investing in short-term rentals, they typically hit test number 3, participate 100 hours and more than anyone else. And we'll get to that here in a second. Now, I keep talking about time, right? 750 hours, more time in real estate, 500 hours, what time counts, what time doesn't count. So the important thing to understand is that you do have to create a time log. You have to track your time on an ongoing basis. If you try to rebuild your time log once you're audited, that is the first thing that the IRS will sniff out. It's going to be very obvious, and they will make notes that you reconstructed your time log under audit. And it will look poorly upon you when you go to tax court if you disagree with the IRS audit findings when they disallow all your passive losses. So tax court is all about establishing trust, right? We want to establish trust with the time that we are logging. So what you want to do is you want to have, it can be a spreadsheet, it can be a manual, like actual logbook, pen and paper. It could be a calendar, Google Calendar, Outlook, all that's fine. The point though, is that you have to have a time log. It has to be accurate. It has to accurately reflect the time that you spent at the property. So don't do, there's cases where people had generalized time from 10 a.m. to 2 p.m. every Saturday. I was at the rental. Were you every Saturday exactly those hours? That seems unrealistic, right? So be very accurate, but also include notes. So here's what you need on your time log. You need to know the hours that you spent at the property, so the start time and the stop time. You need to know the actual property that you spent time at, and you need to leave notes for yourself. What did you actually do while you were there? And can you link to any receipts that you might have in your Dropbox or Google Drive, your storage folder, right? Or QuickBooks Online if you want to link to a specific transaction. But the point is to create a great note-taking system for yourself so that if you are unfortunately audited at some later point, you can very easily and quickly recall things, and you can very easily and quickly rebuff IRS arguments. If you can't commit to creating a time log and maintaining a time log, then real estate professional status is not for you, and neither is short-term rentals. And if you are working with an accounting firm that just looks the other way, maybe they don't care, they don't want to see your time log, they don't ask you for one, or you go, hey, I'm in real estate full-time, and they go, no problem, don't worry about it. Big red flag. Because if they're doing that for you, guess what? They're doing that for all their other clients too. They're just happier to take your money and not create any sort of conflict with you than they are doing it right. And the problem is that in those types of situations, it only takes a handful of that accountant's clients to get audited before you get audited too. It becomes a lot less random when the IRS knows that there's a vein of gold. Why would they waste resources on random audits when they know that they can find success because this one accountant told everybody the wrong thing or had lackluster controls in place for their clients? So point being, every year your accountant should be asking for the time log, and you should be providing that time log. And if you can't provide that time log, do not run this strategy because you will lose under audit. That's why people lose under audits. All right, now let's talk about short-term rentals. So that was real estate professional status. If you qualify as a real estate pro, your rents from rental real estate are not necessarily passive, but if you can materially participate, then they do become non-passive. So you've moved them from the passive bucket and into the non-passive bucket. Now you can cost seg, now you can bonus depreciate, and that's awesome, right? You get to wipe out your income. The problem, of course, is that real estate professional status requires that I work in real estate more than I do my full-time job. So if I have a full-time job, I can't qualify as a real estate pro. That is where short-term rentals come into play. Short-term rentals the IRS doesn't actually have a term called short-term rentals. The IRS just has a term called rental activities. You either have a rental activity or you do not have a rental activity. Rental activities are passive unless you qualify as a real estate pro, right? But if I don't have a rental activity, then I don't have to worry about that caveat because it says rental activities are passive unless you qualify as real estate pro. So what's a rental activity? Well, a rental activity is not a rental where the average period of customer use is 7 days or less. So if I have the average period of customer use be 7 days or less, then I don't have a rental activity. And if I don't have a rental activity, I don't have to worry about qualifying as a real estate pro because, again, only rental activities I have to worry about real estate professional status. Now, I still have to worry about material participation. Okay, so if I buy short-term rental, and if the average period of customer use is 7 days or less, I don't have to worry about real estate professional status, but I do still have to worry about material participation. But here's the big like aha moment is real estate professional status. That's the blocker for people with full-time jobs because one of the tests for real estate professional status is spend more time in real estate than anywhere else. I don't have to worry about that with short-term rentals though. All I have to worry about is material participation. Material participation, I can materially participate while also working a full-time job because if you recall the material participation tests, one of those tests was 100 hours and more than anyone else in that rental activity. So if I spend 100 hours on my short-term rental and nobody else spends more than 100 hours, my cleaners don't, my maintenance guys don't, so I spend 100 hours and more than anyone else, then my short-term rental is non-passive. Right? So I don't have to worry. That's the only test that I have to worry about. 100 hours and more than anyone else. Now my short-term rental is non-passive. I don't have to be a real estate pro. So I can work a full-time job. I can run my business full-time. I can buy a short-term rental, make sure the average period of customer use is 7 days or less, and just make sure that I track my time and I outwork everybody else. I hit 100 hours and I outwork everybody else. If I can do that, then my short-term rental is non-passive. Guess what other income is non-passive? My CPA firm income is non-passive. My W-2 income is non-passive. So if my short-term rental income is non-passive, now I can do a cost seg, I can do bonus depreciation, and I can create a large tax loss. And that tax loss is non-passive, and that non-passive tax loss can offset my W-2 income or my business income. So the key point is that short-term rentals are another way around the passive activity loss rules. Passive activity loss rules say all rental activities are passive unless you qualify as a real estate pro. But this says I don't have a rental activity, so I don't have to worry about real estate pro. I just have to worry about material participation. So what does material participation look like on a short-term rental? A lot of the same that it does on a long-term rental. Self-managing the bookings, communicating with guests, taking photos, posting your listings on VRBO and Airbnb, collecting rents, calling, coordinating with cleaning crews, cleaning the units, doing repairs, et cetera, right? So a lot of the same stuff. You're self-managing. If you have a property manager on your short-term rental, zero chance this is going to work for you. But if you're splitting duties or if you're self-managing, yeah, you can make a short-term rental work. And you can strip out that tax loss, that depreciation in the first year. So here's a couple strategies for you related to short-term rentals just to think about. First is don't hire a property manager. Do it all yourself. That should be pretty clear at this point. But strategy number 2 is to apply strategy number 1 in the first calendar year only. And why would I do that? Because at the end of the day, we're all busy professionals. We don't actually want to manage something full time, right? We want somebody else to do that for us. We want to delegate. It's going to be a higher ROI on our time. We get more leverage over our life and our time when we delegate things. So we want to delegate management of the rentals. But in the year that I'm going to run a cost seg study and get the bonus depreciation, I'm going to self-manage it. In the following year, I'll have a property manager manage it because at that point, I don't really care if it's passive or non-passive. I've already stripped out all that depreciation with bonus depreciation and cost seg, right? So since I've already done that, now I can just let it go. It's fine. And honestly, the property manager will probably do a better job at getting more revenue than I will anyway, in theory. So that's something that you can do to just not make it continuously painful for yourself because managing short-term rentals is hard. It is a hospitality business. I have a short-term rental and It never fails. At 10 o'clock at night when I'm watching a movie with my wife, I get a call. I can't check in. The keypad doesn't work, yada, 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 right? So it is hard. You have to be ready, and you have to, if you want to get 5-star reviews, you have to treat it like a business, and it's hospitality, and you're dealing with a bunch of people, and people have all sorts of expectations, right? So don't make it so hard on yourself forever. You can hire a property manager in the following years. Now, the cool thing about hiring a property manager and just making it passive in future years, so material participation is looked at on an annual basis, January 1st to December 31st. The hours don't carry over, which means that I could buy a short-term rental today. I could self-manage it through the end of the year, and then on January 1st, put a property manager on it. But next year, since the property manager is now on it, that would be a passive activity for me. And that's okay, because I've already done the cost seg and the bonus depreciation. But here's where it gets interesting. Earlier, I mentioned the passive activity netting idea that our large clients and wealthy clients use. Well, I could kind of start doing this myself, right? If I've stripped out all the depreciation in the first year, and I've done the cost seg study, the bonus depreciation, and that created the big tax loss that I was then able to use to offset my income because it's non-passive. If I did all that in the first year, then in future years, because I've stripped out all that depreciation, there's less depreciation in the future years. Now, in long-term rentals, that's typically still not a big deal. Like it's going to, the depreciation that you would still be able to claim in future years will generally shelter the net rental income from taxes. But on a short-term rental, you typically produce more net rental income than you do on a long-term rental. So on short-term rentals in future years, because you've already stripped out all that depreciation, you might actually have net taxable income coming in from that short-term rental, even after depreciation in the future years, because you front-loaded everything, right? But that's not a bad thing if you think about it, because now I have net income from the short-term rental, and it's passive. So now I have passive income. Now I can go buy long-term rentals, and I can use the losses from the long-term rentals to offset the income from my short-term rental. And I don't even have to qualify as a real estate pro on the long-term rentals. I could do it with triple net properties, mobile home parks, whatever I want to do. All I have to do is just make sure that this long-term rental creates tax losses after depreciation, and those tax losses are passive, but the rental income from the short-term rental is now also passive. So I've got passive income from short-term rental, passive losses from long-term rental. They net out, kumbaya. I don't have to qualify as a real estate pro. I don't have to worry about material participation. And I've starting to see the beautiful effects of passive activity netting. Now, I do want to mention on a short-term rental, depreciation is 39 years. Not going to go into why, but you can screenshot this. That is why. But it's not the worst thing in the world being 39 years versus 27 and a half years, which is what real estate is typically depreciated over, because 39-year property gets bonus depreciation on qualified improvement property. That should actually say 60% in 2024, not 100%. But you do get to bonus depreciate qualified improvement property. And qualified improvement property is any property that is that is not the enlargement of a building, any elevator, escalator, or any structural framework of the building, which could be a lot of rehab work, right? Like think about countertops, cabinetry, things like that. It's not structural. So that could be qualified improvement property, immediately bonus eligible. Section 179 can also be used on roofs, HVACs, and fire protection systems for 39-year property. You cannot use Section 179 on 27 and a half year property. So for all of our regular rentals, our long-term rentals, our just our long-term rentals. So for all of our long-term rentals, our multifamily apartments, those types of things, we can't use Section 179. We put a new roof on, we're depreciating over 27 and a half years. But for short-term rentals, it's 39-year property. We can put a new roof on and immediately expense the cost. We can put a new HVAC on and immediately expense the cost thanks to Section 179. I'm going to skip over this slide in the interest of time. I do want to just touch very briefly on where do you report short-term rentals on Schedule C or Schedule E, because what we see accountants do is they go through that Section 469 analysis and they see, oh, there's this carve out that says if your average period of customer use is 7 days or less, you don't have a rental activity. Therefore, you can run your little short-term rental loophole thing, but we're going to put it on Schedule C because that's where you report, because Schedule E is only for rental activities. And that is incorrect analysis. So Section 469 does not talk to Section 1402A. And Section 1402A is where you find language about what type of income is subject to self-employment taxes. And if you do have activities that are subject to self-employment taxes, that goes on Schedule C. But if you don't have activity subject to self-employment taxes, why would you put it on Schedule C? It doesn't make any sense. So what you have to do is you have to look at Section 469 and Section 1402A separately. And when you do that, what you find is that most of these short-term rentals, even though they're not rental activities under Section 469, they don't trip the self-employment tax rules under Section 1402A, so they're still reported on Schedule E. Now, here's when you would trip those self-employment rules. If you are providing daily maid and laundry services to your guests while they stay at your property, if you're providing breakfast or other meals, if you're providing tours, boat tours, walking tours, golf cart tours, whatever it is, if you're doing these things for the convenience of the guests while they stay at your property, now you're kind of running a hotel. That's going to be the Schedule C. That's going to trip Schedule C reporting. That's going to be subject to self-employment taxes. But a lot of us do the repairs, cleaning, maintenance, trash removal after the current tenant leaves and before the next tenant comes in. So we're just turning the unit over. That's not providing substantial services to the guests while they stay at our property. So that's still Schedule E. Here's some more language on should they report it on Schedule C versus E. The big key down here is, are you a real estate dealer or not? And then we see that also in the definitions here of Section 1402A. And I'm not going to go into all this, but you're welcome to screenshot it if you would like. So that is all I've got for you. Thank you very much for listening in. I hope that this was helpful. So just to summarize, we covered the passive activity loss rules, the importance of them, the fact that they were implemented in 1986 because Congress didn't want rich people to use rental real estate as a tax shelter against their income. We then kind of talked about how limited partners could use the passive activity loss rules to avoid paying tax by timing their investments and by thinking a little bit more strategically about what type of investments they're making. We then went into real estate professional status. We talked about the two rules, 750 hours, more time in real estate than anywhere else. But a lot of people with full-time jobs, or everybody with a full-time job, can't qualify as a real estate pro. I did leave out the fact that if you are working a full-time job, but your spouse is stay at home, your spouse can qualify as a real estate pro. And on your jointly filed return, you will still have a real estate professional status tax return. So some of our clients do that. They have the high income earner spouse earning the money. The other spouse stays at home, qualifies as a real estate pro, manages the properties, and they can still use the losses to offset the high income spouse's income. So apologize, I didn't talk about that, but that is a cool trick. And then lastly, we closed it out with short-term rentals. We talked about why short-term rentals can be used even if you're working a full-time job. And then just about like the Schedule C versus the Schedule E reporting, which we see a lot of people mess up. If you have any questions, you're welcome to email me at brandon.hall@hallcpallc.com. You're also welcome to check out our website, or you can scan here for a consultation. It should take you right to the page to fill out a form. That's all I got. I don't know if we have any questions. I can't see them on my end. If we do, I'm happy to stick around. If not, thanks for listening.
Hey, Brandon, thank you so much for that. Yeah, we have a couple questions in the chat. So I'll go ahead and throw them up there and I'll read through them. So it says, in the rental sale example, is the gain considered a capital gain or a passive gain? And if it's a capital gain, can it be used to offset passive losses? He said I'm probably confusing myself, so we can just clear that up.
So it's actually a really, really good question. And the reason that it's a good question is the vast majority of people mess this up, even tax professionals. So the regulations under Section 469 say that when a passive activity is sold at a gain, the gain is considered passive income. So it's still a capital gain, and I'll get to that in a second, but it's also passive income. All right. Now, because it's passive income, that means that passive losses from other passive activities can be used to the extent of the gain. All right. But the passive losses are actually offsetting your ordinary income, not your capital gain income. And so let's go through a quick example. Let's say that you sell a property and you've got $100K capital gain. That $100K is taxed at preferential rates up to 23.8%, right? The long-term capital gain rates. That's what I'm assuming, long-term. But because of the way the passive activity rules are written, that $100,000 is also considered $100,000 of passive income for the purposes of the passive activity loss rules. So if I have another rental that produces $100,000 of tax losses after depreciation, The $100,000 passive loss gets unlocked. Now, where you see the 100K like offset though, is it's going to offset my business income or my W-2 income. So so I sold the property for 100K and it's taxed at preferential rates up to 23.8%. But because it's passive income, I also unlock this 100K of passive losses, but the passive losses offset my W-2 income or my business income, which, can be taxed as high as 37%. So you can actually put yourself in a pretty nice tax position if you can think through that strategically.
Awesome. And another question right here. So it says, so on the first year of stripping out the depreciation topic, does the strategy work on a property that has no mortgage payment? I have one that is being rehabbed and was going to lease it out.
Yeah, that's a great question too. And I apologize. Normally I actually mention this. When you do the cost seg study and when you're pulling the depreciation out of the property, it does not matter how you finance the property. You could do 100% cash, 100% financing, 50-50, 70-30, 30-70, whatever you want to do. Because that depreciation calculation, all they look at is cost basis. What was the actual purchase price of the property minus the cost of land? So financing, how you finance it or whether you finance it will not impact the actual purchase price of the property. So to answer your question, doesn't matter if you have a mortgage payment or not, your calculation for bonus depreciation will be the same.
Awesome. And then what was that email that people could reach out to you at?
Brandon.hall, Hall, at Hall, CPALLC.com.
All right, perfect. I went through that in the chat. So it looks like some people are going to reach out to you individually just regarding their specific situations. And I think that is it as far as the questions go. Brandon, thank you so much. This is something that, like I said in the beginning, that I feel like a lot of people, when they think of the tax savings, they think of the vehicle they're using, not necessarily the actual investment strategy. So I think this is just a whole nother field in their portfolio that they can maximize those tax savings with.
Well, thanks for having me, Zach. I appreciate the kind words, and thank you everybody for tuning in.
Nice. Thank you guys. Have a good weekend.